Welcome to the Wheelbarrow Profits Podcast, where you get multifamily investing made real. Learn from top players in the real estate investment world as they share their secrets with you and discover proven strategies on apartment investing that actually work. To learn more about Wheelbarrow Profits, visit jakeandgino.com, your one-stop shop for everything multifamily. Now to your hosts, Jake and Gino.
You guys ready?
We're ready. I'm ready.
Totally.
Jake,
hello, everybody. This is Jake.
There's no video, so I'm going to go take my shirt off and be shirtless for this.
Dude, this whole thing's been recorded. I'm totally going to stick it to you this week.
Thanks, bro.
Bonus material.
Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, I'm doing better than your microphone, Mr. Stenziano.
Keep your shirt on, big boy. Today's guest is Damion Lupo. Damion paid for his first rental house with a Visa card, bought 150 houses in 7 states over 5 years, and then went through a $20 million meltdown in 2008. Today he runs an Austin-based FinTech dedicated to disrupting Wall Street by getting people off the Wall Street roller coaster and in control of their money and financial future. So without further ado, Damion, welcome to the show.
Jake, Gino, it's great to be here. Thanks for having me, guys.
Hey, Damion.
Hello.
So tell us a little bit about your background, the real estate background, and the transition into FinTech.
Well, it started off, like you said, I found a deal. Actually, a buddy of mine found a deal. We both read Rich Dad, Poor Dad in the late 90s, and he came to me one day when I was selling insurance, and he said, I have a deal. And I said, great, why are you telling me? And he said, well, because you're the money. I mean, you're my partner. And I said, I don't have any money. I'm broke. I don't have any money. I have a credit card. He said, great, that'll work. So we did this deal. I went and did a cash advance, took over somebody's house and put up about $6,000, and then ended up being a real estate investor almost by accident and got really excited about it. So I kind of dove all in and started going to a lot of seminars and just really swimming in the Kool-Aid, not really caring what was conventional because I had dropped out of college, so I wasn't doing conventional anyway. I dropped out 4 times, and I thought this is a really cool way to make a ton of money and create a lot of wealth. And so I started doing everything that the seminar guys and everybody I was listening to was suggesting. I just tried everything, and that led to me almost going bankrupt for my first 6 months. And then I went, wait a second, I got to do something different. Like, I got to return phone calls. I've got to be actively engaged and do everything they tell me and not just the parts that are fun. And as soon as I flipped the switch and went all in, I bought 8 more houses the next month. And then ultimately that led to 150 over the next 5 years and a whole bunch of other stuff, apartment buildings and condos. And then the big finale, or the big moment of crash in 2008, lost a $20 million portfolio. So I learned a ton because of the lessons inherent in failures that you don't get when you're just successful. So that was the snapshot of a decade of real estate. Holy cow.
Damon, before we dive into your extensive experience, I want to ask you one question. What do you tell the youth of today that want to go to college and rack up this huge debt? What is your, I guess, what would you tell them about that?
It's a con. I mean, unless you want to be a doctor, and you need something that is required in that system, it's a complete con to go and create to get a job or to go out and use the world the way it was used 20, 30 years ago by our parents, or even recently. It doesn't work the same way. And basically having the bondage of the debt, or even going out and spending 4 years, the stuff you're going to learn in school, you might learn how to network and connect with people, but the reality is you're not going to learn how to create wealth at all. It's just not going to happen. So to me, it's a waste of time. I think it's smarter to go out, travel the world, connect with people, and get some mentoring from people that are doing actual things and learn from reality and not just an ivory tower.
So I'm up against it right now because my daughter is a senior. She just got into a 4-year college, and I'm up against what you're talking about. And it's hard to go against conventional wisdom. Sometimes as a parent, you're like, oh, your kid didn't get into college, and it's a real struggle. And I totally agree with you. But let's say you're up with a parent. What do you say with them? I'm going to say to you, listen, I like the general knowledge. I want my kid to get that college experience. How do you counter that?
I think one of the things that I would do with any kid is I would do something that's interactive. For me, that's playing cash flow. That's helping them understand viscerally the experience of what money is all about, and then maybe they'll start to connect the dots, because kids don't really learn things if you tell them, but if they feel it by playing, by being in the game, they tend to get it, and they might start changing habits. And there's nothing I know better than actually either doing a deal or playing the game cash flow that Robert Kiyosaki made to get kids to get it. I mean, I've seen kids change their habits and their patterns, behaviors, because they start playing a game and they won't spend money on doodads because they went, I don't like that part of the game where it like peeled the money away from me. So that kind of thing is something that's valuable, and anybody can do that.
It's funny you say that because I have the game, and I have 6 kids, and I play with it. And up until once kids hit 8 years old, we start playing it, because what's great about that game is you have an income statement and a balance sheet, and kids understand assets and liabilities, something that puts money in your pocket and something that takes money out of your pocket. There's really not any more difficult than that. And once they realize that, I totally agree with you on that whole premise, because it's such a powerful lesson, and it's all about impulse buying. If you can challenge a kid not to have that instant gratification as they become adults, they've done a lot of studies. If you can, take care of that instant gratification and wait for that buy, you're going to be such a much better person with money, with relationships, with everything else. So I agree with you 100%. Yeah,
there's another thing too that's really powerful. It's almost a lost art here in the world, and that is just using cash. There's a total disconnect from people, and especially kids, where they're swiping everything and they don't really get money. They don't understand that it actually takes some type of creation or effort or blood, sweat, tears to get that thing. So they're swiping away. If kids are forced to use actual cash, and even though it's clunky and it can be awkward anymore, I think that there's something that they start to get where it's not so ethereal. It's not just an idea that they can spend their parents' money forever, and they start to understand, hey, things actually cost money, and I could run out, and maybe I'll be a little bit smarter about it.
It's funny that you say that, because we play Monopoly too, and now Monopoly has a credit card thing, and I will not buy the game with a credit card because I want them to have that paper money. I want them to see what actual money looks like and pulling money out. So that's another great point. I totally agree with that, because I was in the cash business for years, and I had money at the end of the week. You have that cash. If it's gone, you don't spend anymore. But now that allure of that credit can really totally be damaging to you. So I totally agree with that. Let's jump into you. Let's jump into why real estate, how you got started, and all the different strategies and niches that you've used over the years.
Yeah, definitely. It's interesting because the real estate stuff was when I did my insurance company. I think I was the youngest agent in Farmers Insurance history, and it was a great opportunity to make some good money. The problem was it didn't really give me the opportunity, if I looked at the wealthiest people, to make $1 million a month. $1 million a year would have been pushing it, and I could have gone to that point. So most people might think that's great. $1 million a year. Why are you complaining? For me, there was just something about wanting to be the best, and I had this Trump mentality back then. This is pre-President Trump. This is like, I want to be really big, and I want to do something really big, and I want to tap into my potential. The thing that I hated hearing in high school was, you've got a lot of potential. It felt like somebody was telling me you're basically a reject, and I wanted to really prove something. Like, I don't just have potential, I have results.
I can do it, man.
So yeah, I was like that. I hate hearing that. So I'm gonna go out and I'm gonna show you guys. So I did. I went out and I started buying those houses, and that just led into a lot of other things that gave me the options to create as much wealth as I wanted, because it's kind of a blank slate. It's a canvas where you can create unlimited wealth. If you want to become a gazillionaire or you want to impact the world, you really have the options in real estate. A lot of things are you can kind of tap out. A lot of industries, really, you're sort of in a box in a lot of ways. And this is real estate. There's no real limit. You can take it as far as you want to go. And so that's why I went headfirst into the thing and kept expanding into development, condos, multi-million-dollar flips all over the country. I didn't really see anything I didn't even like. I was looking at land in Nicaragua, which is also a problem. You're all over the place.
I take it all, man.
That's I guess that's my next question. Do you think that was one of your mistakes? I guess not focusing on a specific niche and really drilling down, and instead of drilling wide, digging deep, and then once you have a deep hole, move to the next one.
Yeah, I'll tell you, when I was starting out in Phoenix, and I had about probably 30 or 40 houses, and I went, you know what? I am going to go to another state because I have tapped out Arizona. And I was an idiot, because when you add another state in, another time zone, another complete different culture, you're asking for pain, you're asking for losses. And the truth is, you can make $1 billion in dang near any market, especially a city like Phoenix, if you focus. So even in Phoenix, I did what I call the star pattern investing, where I was investing one corner to the next, and in one day I would spend 8 hours just driving between my houses, which is also a stupid plan. You've got to focus because you just waste so much time and you get exhausted, and therefore you can't really focus. And if you can't focus and you can't spend time on your deals, you're not going to make any money, and you're going to end up staying broke.
So how's your investment strategy changed from that being focusless, I guess, into today's market?
Well, one of the things that I do when I'm looking at deals is I make sure that the deal is sustainable on its own, that I've got pros. In the beginning, I spent a lot of time on my projects where I was the one there, and I didn't have world-class people because a lot of times the deals weren't good enough to have pros priced in. And that it seemed good, and I think a lot of people make this mistake where they think, oh, this deal is good, and they're basically just buying a job. If your deal can't afford the right people, then you're going to end up being exhausted. You're going to end up losing money, and you can't scale. And so now when I'm looking at whether I don't really look at houses anymore. It's the multifamily that I'm looking at. I always make sure that I'm not a part of the ongoing operation, and truly I'm going to be in a limited capacity building up the deal, whether I'm redoing the deal, whether I'm changing things about the deal. I want to make sure I've got the thing priced where it makes sense with other people doing it, because otherwise I just have another job, and I already have too many jobs. I mean, I don't need another one. So the deal has to sustain, and the numbers will prove that to me, or they tell me to run away from it.
So how do you choose the market when you're investing in real estate?
Well, one of the first things I do is I ask, do I want to hang out in this area? And if it's the south side of Chicago, I'm just going to pass. I mean, it's a good market for somebody, but for me, it's got to be some. The what?
White Sox? No.
Well, I mean, there are areas that I just don't want to go because I feel like my background's going to get me killed, and I like my life. I don't want to get killed.
No war zones. No war zones, right?
Well, so I mean, that's one thing. It's just the area. Do I want to spend time there? Is it easy for me to get to? I have a rule where I need to be able to get to somewhere and get back in the same day, or I'm not interested. So I'm not going to go somewhere that's going to take 3 days to get in and out of, and I'm going to have to drive 10 hours each way. So I'm really careful about the locations, and I want to be able to touch it, even though I don't need to live there. So that's, for me, I have a list of rules for businesses and investments, and if I violate one of those rules, typically I end up losing money. I need to know why I'm violating it. I need to be able to touch my deals fairly quickly. So I start off where I am, and I'm not going to just go and look at the entire country to start off with. I'm going to see if I can do my deals where I live, because you tend to pay attention to things, and you don't get killed as easily and get hurt if you're able to see and touch and feel and put your arms around and potentially strangle a few people when you're close.
So what's your buy right? What your buy right criteria as far as, do you look for certain cash on cash return, cap rates?
Typically what I'm looking for something that I can buy, I can create value in, and then it's going to be long-term sustainable. So I'm looking for things that are like B type of properties. Right now I'm doing a lot of lending. I'm lending to people that are doing stuff because it's, to me, that the environment is better for me to do that. When I'm looking at stuff to buy, I'm looking for properties that are going to sustain another correction, which I am certain is coming. I don't know if it's going to be this month or this year, but it will correct. And when you have all these A type of multifamilies that you have a lot of people paying a lot of money, that it's not really sustainable when you have another recession. A lot of those things are going to end up being vacant. And the properties that I like are ones where you can have people, like working people, in those things, and you can have a lot of millennials that will end up taking over those things, because what we know is 80 million millennials are coming to the market or are in the market looking for rentals, and they want small spaces, they want experiences with their friends, and they typically want to rent over buy. And so I'm going to set myself up with my portfolio to serve that group, because that is a big freaking group of people that want to rent these properties.
What do you think about the baby boomers? I think the baby boomers, I don't know if millennials or baby boomers are larger, but they're a really significant size of the population also.
They are. I think one of the things about the baby boomers is they're actually a smaller group than the millennials. When you look at the mass, the 80 million of millennials, the baby boomers, I think it's like 72 million or something. Very big block. What we know about them is that they are starting to pull money out of the stock market, and they're forced to by ERISA, which means all this money's being forced out. And that the 10,000 people that hit 70 and a half, the boomers, every month right now are forcing all this money out because of the 401k laws. That's going to cause a stock market correction, which is why I know a recession is coming, because the law requires this to happen. So they're pulling money out, they're spending it. They're not necessarily looking for the apartments that I'm talking about, and eventually these folks are going to die. I want long-term renters that are called millennials. That's my focus.
It's funny you say that law because my mom is up against it right now, and unfortunately, what happens is it's going to push these people to higher tax brackets. So if we talk about 401ks real quick, the problem with them is the laws are written, and the government can change those laws at any time. And the problem with the 7.5 rule is a lot of people are just going to get pushed into those higher tax brackets, and everyone's always saying, "Yeah, when you retire, you're in that lower tax bracket." I just totally disagree with that. You have no control of your money, and the government can any day rewrite those laws at will. So it sounds like you're not a big 401k guy either, correct?
No, I mean, in fact, I hate the idea of the traditional 401k. If anybody's going to do anything, I mean, this work that I do is on the non-traditional 401ks. It's where you get to control your money, your 401k money, and do real estate investing with it. I like that. What I like even more is the Roth component. And you're right, the laws can change. And they could be grandfathered in. What I think, and I'm willing to bet on, is that we're going to have the Roth component of these type of retirement accounts that's going to stay in play, and it's going to grandfather in people's money, which means basically it doesn't matter what the tax laws are, the tax rates are down the road, because if you've got money in a Roth, after you pay the tax today, you don't pay the tax anytime in the future. And that's kind of awesome when you are getting cash flow or you're selling properties. You don't give a crap if it's 70, 80% like it was in the 50s. It doesn't impact you. So using a Roth piece is a very smart thing to look at.
But do you think a lot of people use that Roth piece? Because the big sell is, hey, you can put money in tax deferred, and when you get older, you retire. So, I mean, how do you see that playing out?
I think people that are looking long term, and if you sit down and think about it, instead of thinking about today, I just don't want to pay taxes today. People are so afraid of paying taxes. It's like when we sell a piece of property and we say, I can't pay capital gains. I must go get a 1031. I must do this, and I must swap out my property for another property so that I don't pay taxes. And people force themselves oftentimes into really bad deals just to avoid taxes. I don't think taxes are bad if you use them strategically, and using them strategically by paying taxes today on your income and then never paying it again, I think can be a really smart thing. I wouldn't not have that as part of my portfolio. It may not be the entire chunk of money I have, but I would absolutely have a Roth chunk, and then think about using it with people like your parents and such, because if you inherit a Roth account, all of a sudden you've got money that you can invest and spend the rest of your life tax-free. That becomes an amazing legacy play to avoid taxes for your family forever.
I want everyone to hear what he just said about the 1031. 1031s are great unless you're rolling out of them and you're getting into a bigger deal and you're overpaying like everyone is now. And yes, the problem with them is when somebody knows you're doing a 1031, your whole negotiation is blown up because they know you're under duress. They know you have a time constraint. So if you're going to do a 1031, you keep it hush, first of all, and you make sure you get a damn good deal, because if not, you're better off paying taxes than getting into a crappy deal. So that's a great point you make about 1031s.
Yeah, I've seen many people that they're pros, and they'll watch, they'll get into a deal, and then they'll push and make somebody squirm on purpose. That is their strategy. They'll go in there and they'll cut them up during the escrow period. And with what you just said, if you've got a 1031 rolling and they know about it, you are a target. I mean, they're going to crush you.
I agree with that. How has your investment strategy changed over the last, 10 years from when you crapped out and you lost that big portfolio till now?
One of the best things about having a meltdown where you lose tens of millions of dollars is you start to feel things differently. Back then, all I felt was hedonistic consumption bliss. I mean, I was having fun spending money, and I didn't really even pay attention to the market falling apart. When I sold off 100 plus houses and I had millions of dollars, I was having a good time. And so I thought, well, shoot, I'm super smart. I'll go out and do some more. So I doubled down, tripled down, and did a lot more, not really paying attention to the fact that the market was frothy, because I couldn't feel it, because I hadn't been through the pain. Once you go through the pain, it's really fascinating. This is why mentors and coaches that have been through stuff are so valuable, because they can feel things and see things beyond the horizon. It's like they have X-ray vision. And so now I look at stuff and I feel it and I go, this feels, smells, tastes, looks just like what I experienced 10 years ago. So I'm more conservative. I'm also really, I ask more questions and I dig into things. So I'm doing smarter deals. I don't worry about losing money now because I vet the deals, and I see people doing a lot of the same stuff I did 10 years ago. And I go, you guys are investing how much in what? And they go, well, it's this deal, and this guy says I'm going to make 12%. And I go, what's the deal? Well, I'm not totally sure, but it's like he never loses money. And I go, oh my gosh, we are in 2007. So I see things differently because of the scars.
Damion, your story sounds a lot like, eerily like Rich Dad Poor Dad's. When he was in his 20s, he had the Surfer Wallet company, making tons of money, but at the end, I guess he was loosey-goosey, and he didn't have the due diligence that, young people tend to have, and I guess that's why you resonate a lot with Rich Dad's story, correct?
I do, and it's funny, but we think we're Velcro, that we're going to stick to money, or money's going to stick to us. We turn out, oh wait, we're Teflon. Everything's flying off of us, and we really made the same mistakes. We went out there and thought we were super smart. And I remember in 2002, I was in Austin, Texas, where I live now, with a mentor, and there were a group of us, like 20 of us, 15 of us were in real estate doing basically the same thing. And this guy said, you guys are all going to end up losing your stuff. You should put some money on the side. Understand, things cycle. And we were like, you are crazy, man. We are way smarter, and we have you. And we all got whacked. And it was because we hadn't been through this stuff to really understand it. And he just shook his head. And we all thought, we don't need to go bankrupt. We don't need to lose money. I think it's important to find ways to make mistakes and lose some money. It's not that you go lose all your money like I did or Robert did, but to go out there. If you're making mistakes and losing money, it means you're taking action. If you never make a mistake, if somebody tells you they've never lost money, run. Do not give them money, because if they've never made a mistake, you're asking to be the first one that it ever happens to. So I'm really leery of people that tell me they have a perfect track record. I like experience. I like people that have survived through a morass or an apocalypse.
So what could you have done differently amassing that large portfolio before the whole market crash? Were you buying for cash flow, or were you just buying for cap appreciation and speculation?
I was actually doing the really boring thing. I was buying for cash flow. I did I'm going to buy a house. I'm going to make $100 a month on this thing, and I'm going to buy a whole bunch of these things, and I'm going to build up real cash flow money. I mean, it was based on the board game. I was playing that game all the time, and so people that are just flipping, I say you're missing the whole point of wealth creation. The financial freedom is all about this thing that keeps coming in, and it's residual. It's not passive. You don't just check out. But it is residual, and you don't have to do that same deal over and over again. It's sexier when you make $20,000, $30,000, $50,000, and at the same time, you got to keep doing that, because the problem is you'll spend the $20,000, $30,000, $50,000, and then you got to go do it every month. And so I was buying the houses, and eventually went into the apartments with the idea that I was going to build up this residual. And I made a mistake. I got super full of myself, thinking that I deserved to have all the bling, and so I started doing the bling in my 20s, the Ferraris and the American Express black cards. And I started harvesting my equity. Huge mistake. Take a note on this. I mean, write this down, guys. You're listening. Don't harvest your equity in the middle of building up your wealth. I was selling off my equity in chunks to people that wanted residual, that were smarter than me. And all I ended up with was a portfolio of properties that were paying other people. And I was spending the money as fast as I could create it. That's a disaster, but it's a very common thing for people to think, I can just keep doing this and I'll never run out of energy or deals, and you just get exhausted.
So if you hadn't done that, you would still have that portfolio today. Is that what you're saying?
I would. The thing that I also did when the market went up, and part of this is smart, when the market goes nutty and it's exploding and you've got tons of equity, when your house goes from 100 to 250, it's not necessarily a terrible idea to sell it, take the 150, and even go on the sidelines. Because if you're making $200 a month and you've got $150,000 in equity, I think that's kind of a stupid play on equity. Your return on equity is terrible. So that can be smart, to take the money out of play and wait for the next correction. What I was doing is I wasn't taking it out of play. I was just going out there and playing with it. And it ended up just going away. So I had no property and no money, and some really interesting experiences. So I wouldn't have done it with all the properties. I would have done it with some of them, enjoyed it, taken some of the money out of play, and then kept some of the properties going. I think you can have a balance there. And the mistake I made is I wasn't listening to people. This is the value in having a bald or gray-haired coach or mentor that's been through things that you respect and listen to. I stopped listening to people. And when I did that, I didn't have the experience to guide me. I had my gut, and my gut was just full of bliss. It was full of, I am so smart, and I wasn't that smart. So I would have definitely had the mentor close by that I kept listening to. Huge mistake, and I wouldn't make it again.
It's funny you say that, Damion, because Jake and I have that same exact strategy. We have the refi and roll, we call it. And thank God I'm a little bit older, because it's the same thing. We refied over $4 million over the last 2.5 years. And, we haven't syndicated yet, because we've been blessed with actually pulling the money out and repurposing it into the next deal. So, if we were younger, we might have gone down that same path. So it's important to actually put your money back to work instead of doing all the fun stuff. Once you have $30,000, $40,000, $50,000 a month coming in, that's when you can go out and you can buy a Ferrari and actually just buy the whole thing or do whatever you want when you want to lease it. So that's a huge lesson for everybody out there. Work with the equity. Yeah, make the equity work for you.
Yeah, and it's I think people get a little premature in terms of what they think they can afford. Like when I bought my Ferrari, I was thinking I can afford this thing. I just made $1 million. Now, if I had made $10 million, maybe, but making $1 million and thinking you can afford a Ferrari, a $250,000 rocket that you're going to ride around on is a stupid plan for people to think. I like what Grant Cardone says. He says just stay broke, keep yourself broke, make some money, put it away. Keep it going until you have so much money it doesn't make any difference. And when you have $1 million, going and buying a Ferrari makes a difference because you still start thinking about your little light on the dashboard that flips up and it costs you $10,000. It actually emotionally impacts you. When you've got $10 million, you've got $100,000, $200,000 a month coming in. You're not going to be that concerned about it. And I think you have to be patient. And so doing deals with guys like you would make more sense to me. I wouldn't do deals with guys that are in their 20s now. Most likely because they just don't have a clue. There's too much testosterone, and they don't have the patience or the focus. And so it's something that I'm really careful about in terms of age. So I think what you guys are doing with the equity harvesting with refi, I think you can do some smart things with that. People in their 20s typically don't do very many smart things, period.
It's funny you say that, Damion, because I think as I've gotten older, money for me is not the cause, it's the result. I always thought younger, money was always the cause. That's what I'm working for. I'm working for money and working for money. But as you get older, that's not really what you're working for. I mean, you're working for, I guess, you're working because you want to make a difference, you want to grow, you want to contribute. And alas, here comes the money. So you look at it differently. But I think when you were younger, it's just all like you said about the bling. And as you get older, the bling gets boring. You really don't want to deal with that. You want to start thinking about generational wealth, how to affect others, how to give back to others, how to give back to your family. So you have to go through that transition and go through that growth period, and I think everybody does. So hats off to you.
Well, it's funny that back I remember in my 20s, I was really excited about the speed of everything. Everything had to be fast, and the universe was giving me some feedback I didn't listen to, and that's a good lesson for everybody to pay attention to the signs. You get signs that are, hey, you're doing the right thing, you're on the right path, and you get signs saying, get off of this path. I went skydiving 4 times. The first 2 times I lost my arms. Both of my arms were atrophied. The third time my chute failed and I almost fell into a power line. And the 4th time, because I just didn't pay attention to the universe, I jumped, landed, everything was good, and I found out the space shuttle had exploded over me. And I went, wait a second, maybe I should be not doing this anymore. We have to pay attention to these signs and really understand that it's not an accident that we're seeing things or that sometimes there's so much pain. It may mean that we need to divert, and it can't be about the cash. If it's just about the cash, you're going to, I can guarantee you eventually you're going to blow up. What you're doing is the right way. It's finding something that's deeper, that's more meaningful, and the side effect is the cash. And that's the cool part. When you have something that's more important, the cash just starts to flow, and then you really go, wow, I don't have to worry about this. I don't have to stress about this. I need to focus on what matters, why I'm here.
Jake and I talk a lot about scaling our business, adding team members. How have you built your team? I mean, you've got multiple businesses going on. What do you look for in a team member, and how have you scaled up?
Well, before, in the beginning, I just looked at proximity. I mean, if I knew you from high school, or if you happened to be my neighbor and you were an accountant, I was going to hire you. I mean, it was just if I bumped into you, it's like how a lot of people date. Hey, I ran into you in a bar, so therefore I'm going to date you. Nothing in common, but hey, let's go. Now everything is driven based on my values, and there's 6 of them. This is a huge difference between 15 years ago. I didn't have values. I guess my value was more cash. And so today there are these 6 values that are 10x growth, transparency, relationship, self-responsibility. And these values drive the people in my life. So if I'm looking at who's going to come on board, who's going to be my next CFO, or who's going to be an advisor, or who's going to be my contractor, I want to know that they're going to be transparent. I want to know that they're going to be self-responsible. If they have those, then they clear that path for us to be in a relationship together, for us to connect. If they don't embody those things, they filter themselves right out, and I won't touch them. And it's how I base all my decisions, and it makes it really easy because I know either this is in line with 10x thinking, or this is not. And if it's not, then it's an X. I'm out. The people, it's a powerful way to decide who's going to be in your life once you really decide what values matter most, and not 100. I mean, we're talking a handful that you can rattle off and anytime somebody asks and they're deeply inside you, they become part of your cells. I mean, they really drive everything you are. So that's how I decide who's going to be on the team.
Do you have any horror stories about hiring team members that you just said, "Oh man, I should have hired him. He lost me a ton of money"?
How many weeks do we have to do this? Yeah, one of the big ones when I bought my apartment complex that when I moved into the multi units in Memphis, I bought this thing and I met a guy that was just really charismatic, really nice guy, laughed a lot, and I thought, this is a great guy. And this great guy ran my deal right off a cliff. And because I wasn't in Memphis, I was detached from him. I wasn't really paying attention. I'd fly in and he would show me some units that had been rehabbed, and I'd go, great, it looks like paint. Okay, cool. So I felt like there was progress, and he would just keep calling me, hey, I need another $100,000 this week. So I kept sending money. And ultimately, about a year into this thing, I went to the property, and my hard money lender came out, and we all looked at it, and he said, you literally have another $2 million to go in this thing. Where are you going to get the money? And I said, I'm out of money. And the charisma of this guy ended up costing me $2 million out of pocket, and I lost the property, and I gave it back to the hard money lender. So if somebody's really friendly and you're doing business with them just because you like them, the likelihood is you're not basing it on all the right things. And so as much as I like to like people that I'm doing business with, I want to know that they know what they're doing. I want to know that they're making decisions based on integrity. And I didn't vet him. I mean, I really didn't go deep with this guy, and I wasn't there because it was a brand new relationship to understand how he was operating day to day. So that was a huge mistake. And, it was $2 million. It was kind of painful.
So let me ask you, we're looking into the Memphis market. What is your, I guess, take on it? Was it the deal? Was it the guy? Was it the market? What was about that deal that really went south?
Oh, that one's easy. It was me. I mean, I was the idiot in the deal. I was the guy that was making bad decisions. You guys could probably do that same deal and make a couple $1 million if you were focused on it and you didn't make the same mistakes. But it was me making those mistakes. It wasn't paying attention. I think there's an awesome opportunity in Memphis. I was buying in the Graceland area by Elvis's house, and it's a very, very dangerous area. I mean, I had armed security there. I had the pipes torn out of my complex twice in less than 12 months. So explain that one to Lloyd's of London, how you end up having that happen twice, where all the copper's pulled out and you file these claims. It got so bad that my armed security guard, I mean, this is a real part. This sucks. My armed security guard was killed on my property the second time these things were stolen. So, I mean, stuff got real, and it was terrible. It was a horrible experience. I would be very, very careful about the areas. This is why I said the south side of Chicago. There may be some nice areas, but I don't want people dying in my projects. It's not worth it.
So what led you to buy this property?
So I had a partner. I had a couple partners, and one of them knew a guy. I mean, if you hear somebody say, I know a guy, that should send up some red flags. I don't care if you know a guy, man. I don't want to talk to you. So he said, I know a guy. Let's go talk to him. Let's go look at these deals. And he didn't live there. I didn't live there. Nobody lived in Memphis. And we went out and met this guy, and he was a nice guy, and we were all martial artists, and we bonded over beers. And he showed us a bunch of properties, and we thought, hey, this is cool. So I ended up in this deal because he knew a guy, and the guy made money when we bought the deal as a broker. And so it was in his self-interest for us to close that thing. And I remember all my alert flags went up on me when we were getting close to closing this thing, and my original lender said, I'm out. And I went, crap, I got $40,000 in hard earnest money. I'm going to lose this $40,000. And because I didn't have the experience of what it feels like to lose seven figures, I went, $40,000 is a lot to just walk away from. So this hard money lender, the last week before we're supposed to close, pops up and he says, yeah, I'll fund your deal. I've owned that property before, so I'll go ahead and lend you the money. I should have known. This guy was a shark. He knew exactly what he was doing. He knew I was going to lose my butt. And he popped in, he wrote the check, and he funded my rehab until I begged for mercy and cried uncle. And so we were doing this deal with a shark, and none of us was there. It was a mistake that nobody was on site, and everybody was making money along the way except for me. It was really on my back. So I just wasn't paying attention. I was going too fast without measuring things.
Now, I know we don't have 2 weeks for this question, but what's your best real estate investing type advice or tip for the listener?
I think if you constantly focus on what does this property look like in 5 years, and am I still happy to have it, and is it still going to make sense in 5 years, regardless of what's happening in the economy, it forces you to do better deals than just saying, okay, if I can do this thing right now, I'm just going to make my money right now. And it's not about the speculation. Forget about the speculation. Make sure that the deal makes sense with zero appreciation or anything. If you do deals with that, and when you can't figure that out, this is where the wisdom of the gray and the bald comes in. And having people say, okay, let's look at this deal in 2025. Does it still make sense? Do you still want to own this thing? Then you're starting to create wealth. You're not just doing a job that's making you money so you can have a good time. It's really looking at these things as part of your foundation, as your asset base that's going to stick to your balance sheet, not just slide off of it.
We need to find the Gandalf of real estate.
The Gandalf is your friend. Seriously, go find that guy.
On a personal success note, what is your best daily habit for success?
The best daily habit I have is my morning ritual, the Savers ritual that I learned from Hal, and it's stuff that I was doing before. And the Savers is the silence where I meditate, and this literally could be for a minute, but I do that, and I look at my vision. I have a daily affirmation, and I absolutely journal and write my goals down every morning. And what this does, and I make my bed. And the reason I do these things is because it sets me up for success. And I learned this from a former Navy SEAL. He said every day we make our bed. And it's just something, it's a ritual we get into. And one of the cool things is you always have a success to start your day. First thing you do, get out of bed, you make your bed. And you want to set yourself up with that mindset. You make your bed, you do your journal, you write your goals. You're already on this success path. And if you get a little exercise in there, even if it's a few push-ups, you start off your day feeling differently. And you run into your next thing going, I'm already on the success track. I'm not chasing the 8-ball, even if you have a pile of stuff to do. So I do that because it physically sets me up. It pushes me into the mind space of you're rocking and rolling, man. You're on it. Instead of, holy crap, I got a lot to do today. And I think we start off our days like that and we just go, it's going to be an exhausting one. I'm fired up. I get on the show with you guys and I'm ready to rock and roll. And you can probably tell I'm excited because right before the call, I got on into my journal, into my goal book that I got from Grant, the 10X planner. And I was in there writing my goals, thinking about today, thinking about the targets I have and writing about my quotes. I mean, that's how I start every day. And it changes the energy of how I show up everywhere.
Hats off to all the mothers out there. You hear this, young men? Make your bed in the morning. It pays off, right?
Everything.
Well, Jake, my success is I can always say, hey, Julia, can you make the bed for me? I'm like, the success is, yes, I got somebody to make the bed for me.
See, Gino's scaling the business. You can write this down, too. Gino has learned to scale. Good job, G-Day.
Team members, get them all involved, Jake. You know what I'm saying?
Gino, I think you missed the point, my friend. I don't know if that's the exact thing I was saying, but...
Sorry.
I like it.
That's awesome.
So tell us about a mistake that you made in the real estate game that has been actually a positive for you, that you learned something that the listeners can say, wow, I'm not going to make that same mistake. Something to share that's good for the listeners.
One of the things that I thought was a big mess, and I don't necessarily condone this or think this is a great idea, but the fact that I went out and did lose this money, and for a couple of years I thought, oh my gosh, I've lost my money, I've lost who I am because I had tied my self-worth and net worth together. And what I realized after a couple of years was there's a tremendous opportunity to learn from that, and I'm not my balance sheet, and I didn't get eaten by a saber-toothed tiger. Like, we have this thing that we think if we go make a mistake, if we try something that we don't fully understand, that we're going to be eaten. There's a Tyrannosaurus Rex in the bushes or something. It's going to pop out and bite our head off. And when you realize that you just end up growing by these things, and so you don't have to go lose $20 million. I think if you go make a mistake and you buy a property and it turns out to be a turd, then, hey, you know what? You learned something. The mistake is not taking any action. The mistake is staying in this constant state of, I'm going to learn more and I'm not going to do anything. That's great. You're going to be an academic. And we put those in schools and they teach our kids to be more academics, and you never create any wealth. You never create any freedom. So the commitment to going and doing something is powerful. Mel Robbins mentioned something on a show recently. It was actually with Kim Kiyosaki, and she talks about her countdown thing that she does. And it's where when she's thinking about something, she says, okay, I'm going to count down to disrupt my brain. I'm going to do the 5, 4, 3, 2, 1, go. And it it breaks your pattern and it forces you to take action. So if we're sitting there looking at deals or we're thinking about what we're going to do next, instead of staying in our brain, if we trigger the countdown, we'll go forward, and it disrupts our fear around making these mistakes. I think that's the killer for people in their lives. They're afraid of making mistakes because of judgment. I was so focused on doing things to prove to people that I was worth something. I was focused on spending money to impress people that I didn't really know on things I really couldn't afford with money that wasn't even mine. I mean, this is my pattern, or it was. And if we can break out of that and start asking the question, why am I doing this? It finds a deeper reason for us to continue to take action and not worry so much about these mistakes that we're making. So there's an endless amount of things that we can learn if we're willing to take action, and we just grow and get better. And that's what I would encourage people to continue to do, and stop worrying about the judgment of others or making a mistake. It doesn't really make any difference in the long run.
Give us a book that you really enjoy that's helped you, that's not Rich Dad, Poor Dad, or a very typical book that everyone else has already read.
Mastery, George Leonard. He's a guy that I've studied. He passed away. He's a martial artist, and that's a big part of my background that I've been teaching and training for 20 years with Yokido. And he wrote a number of books. One of them is Mastery. It really applies to all of us and how we approach life, whether we're approaching it with a success point where we're just trying to get to something, or whether we're trying to become something. And with Mastery, it's all about becoming something and a pursuit of mastery that doesn't end until you stop breathing. And I think I know that this is valuable for every single person. It's a book I study. I don't just read it. I read it over and over, and I think through and I talk about it with people. I would put that on your reading list, anybody that hasn't read it.
It's really cool. Every week we get one of these books where people are saying, I've read this book, or I read it once a year, and it's like it's their jam, right? And it's the one book that really has changed their lives. It's pretty cool.
It is cool.
Discuss your best deal and why.
The best deal I ever did, I bought, and it was a silly little house that I was making a few $100s a month on, and I bought the house. I solved a problem. Some people were moving out of Phoenix, and I bought this house. I took over. I think I gave them like $5,000 and took over this mortgage. And when I did this, I sold it to a guy I was the bank, so he was making payments to me, and it was a few $100, and then he was behind all the time. So I had my late fees. So every month I was making like $500 on this thing. So $500 a month over a year, I made all my money back the first year. And the guy stayed with me for 5 years. And so it ended up being a really solid deal. He never called me about anything. He just made his payments. And the thing that was so great about it is I just sat there and collected payments. I did the deal one time, and it kept paying because I wasn't trying to force it. I wasn't trying to flip it. 5 years passed, and then all of a sudden the market went nuts, and the property more than doubled. I think it damn near tripled. And when I sold it, it wasn't because I was trying to force something. It was the opposite of the flips. I was trying to jam out $20,000, $30,000. I mean, I think this house made about $200,000 when I ended up selling it. And it was because I did it with the long-term intention. It wasn't because I was trying to force something. So I wasn't playing hunter. I was playing gatherer. I was definitely being a gardener. And it's that type of mentality that allowed me to create some serious wealth, because that $500 a month turned into a couple $100,000. And all of a sudden, you can do a lot with $200,000 if you're smart. So doing those type of deals and being patient can make you a fortune.
Wealth builder, I like it. What project are you excited about right now?
I'm excited like crazy about disrupting Wall Street. I love the idea of empowering people with the idea that they can take their money out of the Wall Street roller coaster, get off that thing, get unshackled from the bondage, and go find ways to invest in things like you guys are talking about, the multifamily, the real estate that we can control, and get out of this con game that is Wall Street. I love doing that. It's fun to see people get out of the anxiety space of what's the market going to do day to day, and see them over months and maybe a year or two shift into a place of freedom where they just go, I don't care what's happening there because I'm in control of my life and I can do it. It doesn't matter what the economy does. It doesn't matter what Wall Street or the stock market does. That to me is priceless. And the wealth that gets created, that I create from that, is a definite side effect of all these people that are being unshackled. So you can't even imagine how powerful that is to see people going into a space of freedom, creating the freedom, and especially after seeing my family, my parents, being stuck and not having that freedom, and knowing that other people's parents are not going to be in that space, it's a big deal for me. So I'm doing that as much as I can to have as many millions of people free from that bondage as possible and put them in charge of their own lives. So
how are you doing that?
Well, the actual process that we're doing, we're showing people that they can take control of their 401k, their IRA, all their investment money, pull it out of Wall Street, and we put it into a vehicle where they're able to write a check for their investments. They're not stuck inside that Wall Street system anymore. We're essentially rolling their money over into a self-directed thing called a QRP. And at that point, they have a checkbook with their retirement money, and they get to invest in things like real estate, precious metals, stuff that they can control, stuff that they can feel, stuff that they can hold.
So do you focus more on the sponsors? Because I know when you get into deals like that and you get into self-directed, you're looking at deals. It's not really the deal, correct, Damion? It's more the person, and it's more the sponsor of the deal, correct?
Ask me the question a little bit differently. I'm not
sure. When people start take their own money and you take possession of your self-directed and you're looking at deals, you're not really looking at the deals themselves. Aren't you looking more at the sponsors and people who are putting the deals together? Isn't that one big part of the due diligence process of that strategy?
Well, it depends on the type of deal you're doing. When people pull their money, they're oftentimes buying property. They're buying property themselves that they're going to have as rental property. I think your question is actually it's a bigger question than just what I'm doing. It's when you're looking at deals and there's somebody else running them, like it's going to be a syndication or something. The first thing that you should be doing is vetting and digging into the people that are running it, the sponsor, the promoter, whatever. If you're not starting there, you're crazy. I don't care how good the deal is. If you have a great deal and a bad sponsor or a bad promoter, you're going to get hurt. You can have a terrible deal and a great sponsor, and there's a higher likelihood you're going to do well. You've got to start with that person that's running that thing. So I think you just open something up that's incredibly important.
Yeah, no doubt. So what's the best way for listeners to get a hold of you if they want to find out more?
Best way is to visit totalcontrolfinancial.com. And there's a way to reach out to me. I've got a book on what we do on the QRP that people can get a hold of. You can get a free copy there, and really open yourself up to the options. One of the things that's valuable for people to do is to understand this tool, because we will run out of money, and there's lots of deals out there, but eventually we'll run out of money. And if you understand that there's trillions of dollars sitting stuck in Wall Street, and you go find deals, if you know this tool, then you can potentially ask your neighbor, your friends, your family about, hey, you want to do this deal, or you want to look at this deal. You have trapped money that I can show you how to untap and get a hold of with your stuck 401k money. I can show you how to get a hold of that with your QRP. Now you have a huge line of credit or a huge line of cash that you can tap into if you understand the QRP tool. So I would encourage everybody to get a copy of the book and understand what this is. It'll open your resources up in a big way.
Very cool. So guys, check it out. And if you guys are finding value in the podcast, as always, go on iTunes, give us a like, give us a subscribe, give us a review. And, really appreciate having you on the show today. Gino, you got anything else?
Yeah, just a couple takeaways. First thing is, in your 20s, don't focus on the bling. Hit the cash flow game. Read Robert Kiyosaki. After you read Robert Kiyosaki, why? Read Wheelbarrow Profits, how? Visit Damion's site, because I think self-directed IRAs, that's a huge pile of cash for all the multifamily investors listening, because if you're going to start syndicating money, you can't find money. Well, there's a lot of money, like Damion said, sitting in those, and people are doing it. I mean, that's what Jake and I did. I just actually blew up my self-directed IRA, just pulled it all out, took the 10% hit. But you know what? I think there's so much money in that space that you can definitely go out. I know syndicators out there who say up to 40% of their money comes from self-directed IRA. So that's an excellent tip for you guys out there to listen. And just be sure to go on Damion's site. Take a look at his site. He's got extensive experience, extensive mistakes, extensive successes. Get his book, read the book. I think you guys are going to really enjoy it. And I'm really glad that he was on here sharing his pain and sharing his successes as well.
One quick thing that I want to make sure that the listeners hear and you guys understand, that most people miss this thing, is that the difference between the self-directed IRA and the QRP is the QRP with real estate, you can use debt, you can actually leverage, and you're not going to pay taxes on your investments.
Oh, good. Yes.
The self-directed IRA, you do pay taxes if you use leverage.
You
get
get
rid of the self-directed IRAs if you get the UBIT, the unrelated debt and finance income. Make sure that you understand that, because you're going to give away a third of your money to taxes if you use an IRA versus a QRP. No tax with the QRP. It's night and day, fundamentally different.
Thank you for that. That's an excellent tip also, guys. So be sure to visit that. Thanks.
Very cool. All right, guys. Well, that's a wrap. Appreciate the time, Damion. And Gino, have a good day.
Bye, guys.
Thanks, guys.
We trust that you enjoyed the Wheelbarrow Profits podcast. Visit jakeandgino.com, your one-stop shop for everything multifamily. See you next time when Jake and Gino share more of their investing secrets with you.